Hello, I'm Ryan Lightfoot-Amanoff of Kepler Trust Intelligence, and welcome to the third of our week of presentations looking at all things small companies. Today, we stay in the UK and are joined by Richard Staveley, manager of the Rockwood Strategic Trust. Rockwood owns a highly concentrated portfolio of companies from the lowest end of the market cap spectrum, and Richard has generated very impressive performance over the past few years to be one of the best performers in the small cap sector. For those of you who are new to our format, welcome. Richard will present for about 25 to 30 minutes before handing over for Q&A, which is scheduled to last around 15 minutes. If you have any questions as we go along, please use the box in the corner and I'll put all of these to Richard at the end of the presentation. So without any further ado, I'm delighted to hand over to Richard Staveley to talk through his trust and the microcap sector.
Thanks very much, Ryan, and thank you very much for everybody that's tuned in today. I understand from Ryan there's a mix of people who know Rockwood and also those that haven't stumbled across Rockwood before. So for those that have heard some of these slides that I'll go through, I apologise, but I'll do it at a reasonable pace so that we can get on to both the portfolios so you can get everyone can have an update and see what's in that, and then crack into Q&A. So thank you very much. We actually had our results this morning. So for those that missed that or don't check their RNSs first thing, those are all downloadable. It's a bit backward looking, but there's quite a lot of detail about some of our stocks we're invested in there. And the annual report is out as well and will be on our website. So I'd encourage those that are interested in doing a bit more work to have a look at that document. So without further ado, Rockwood, yeah, we're a specialist fund. We're definitely differentiated from most UK equity funds and the vast majority of UK small cap funds. And I think that differentiation has led to a proven strategy in this market of UK microcaps. So the maximum size company we can buy is 250 million market cap, but you'll see most of the stocks are much smaller. We target we don't have a benchmark per se. What we do is we target 15% internal rates of return in our underlying investments over the medium term. What that means in practice is we basically look for stocks that can at least double in value over 3 to 5 years. And the maths works its way through so that a stock that doubles in 5 years on the compounding basis will give you 15% a year. If we do it ahead of time in 3 years, we'll make 25% a year, and hopefully some of those will make up for the ones that take slightly longer or don't meet our target returns. But if we do continue to do at least 15% a year on rolling 3 to 5 year bases, we will remain the number one fund in the UK. We're value investors. Not lots of those about these days, but we are. We've had that mindset for many years, and we look for recovery situations in the main. It's the majority of the portfolio, but not exclusively recovery situations. And we have a concentrated portfolio, as Ryan said. We've currently got 20 holdings. Finally, another important differentiator is that we're active. So we get engaged with the companies that we invest in. We take meaningful stakes in them, and we often put people's on the boards. And so we are an active investor as well as very active in terms of our profile versus any indice like the AIM or the FTSE small cap or something like that. I'm 100% focused on this portfolio. It's the only job I have or do. I don't have other portfolio responsibilities or other business responsibilities. And I've personally invested in the fund. Me and my family own just under 1.2% of the fund now. And Christopher Mills, which is where Rockwood Strategic is run from, on Harwood Capital, who founded Harwood Capital and runs a couple of investment trusts himself, has purchased about just over 20% of the portfolio. So we are really aligned with the shareholders over the long term for delivering a real, absolute portfolio returns for you. And we've got real skin in the game. So for those that are, this is a little bit about small cap, I think, from a Kepler perspective. So I'd just remind everyone that small cap investing actually is fantastic. It really does work over the long term. And for those that have a long-term investment horizon, you'd actually be sort of slightly certified, be mad not to have some exposure to small cap shares over the period of your investing and saving life. The chart on the right-hand side of the page shows that £1 invested in 1955 would have grown in the bottom 10% of the market to just over £9,000, a fantastic long-term return. Interestingly, though, I draw your eyes to the £22,000 over £22,000 return that has been created from the bottom 2% of the market. And I highlight this because a lot of the small cap funds these days are focused on the £9,000 return, the bottom 10% of the market, which is why quite a lot of these UK small companies funds tend to actually own like £1 billion companies and even quite a lot more in some instances. And we really are in this really inefficient space where a lot of these fund managers don't look anymore or are not allowed to because they're worried about the liquidity issues aligned against their open-ended funds that they mainly run. So sentiment, it'll be no surprise to most of you, it's been pretty poor for some time. Lots of the death of small cap and the death of the UK and all that sort of jazz. I do draw your attention to this great quote from the wonderful Sir John Templeton, about markets, and I would suggest that things are pretty pessimistic, maybe slightly starting to improve, but overall people are very pessimistic, apart from UK small cap managers who all tend to be saying that this is one of the best opportunities they've seen for decades. The far left Business Week magazine column, I managed to dig out, I think that's a cracker. It was the death of equities. They called that out in 1979. I think you know what happened next. So the UK valuation matrix for UK stocks has been under pressure for some time. I'm not going to get into any debate about the whys and wherefores of Brexit, but you'll see that on the chart on the left that the red lines are depicting the discount or the green lines premium of UK equities to global shares. And you can see that from about the referendum result onwards, there's been a gradual increasingly discount of UK shares to global shares. Now, I'm sure some of you will be aware that that's partly to do with the high valuations of particular US tech stocks that are driving the valuation of the US market. But I think what's interesting is it's actually at its worst now. It's got worse and worse. It hasn't started getting better. We're actually at the biggest discount it's ever been since this was tracked since 1989. You can also see on the right-hand side of the page that the bottom, the companies under £250 million on average are the cheapest part of the UK market. Performance of Rockwood, we're really, really pleased. This is performance to Q1, although with our results today, we highlighted we are actually now the #1 small companies fund over the last 1 year, as well as 3 and 5 years and year to date, actually. We're pleased, really proud of this performance. We think it's sustainable because it's due to the process and philosophy that we undertake, which isn't going to change. And we're pleased that it's been delivered in both buoyant markets and more difficult markets. In fact, in the year to March 2024, the fund was up just 5.1%, but the AIM market fell just over 8%. So we're sort of protecting capital in more difficult times as well as growing it and when markets are a bit more risk on. The names of the companies on the right-hand side of this slide show the takeovers and the realizations we've had, not all from takeovers, in the last few years. And then really that is it. There aren't lots of other we're not a fund manager with 80 stocks that's dealing all the time and got lots of stocks to talk about. These are the stocks we've had, these are the returns that we've made, and you'll see that in all instances, apart from one actually, there we've realized more than our target returns of 15% per year during the holding period of the investment. So it's a huge universe still. Few people complaining there aren't enough stocks, but if you run a 100 stock portfolio, it's more of a problem than if you've got a 20 stock portfolio. Lots of brokers complaining there aren't enough IPOs, but that's how they make their money. I think there's plenty of opportunity in the UK market for us to deliver our returns. We think our recovery mindset's quite differentiated. The handful of people that play in the microcap space actually a bit more style agnostic, or actually maybe even a bit more growth focused than we are. So they tend to not even look at the ones that we're looking at because their sort of turnaround's a bit more tricky at the point of entry. Because we've got a much smaller portfolio in terms of numbers of shares than the other fund managers, that creates a huge amount of additional time. And believe you me, I did used to run more broader portfolios, and it is there is a lot more news flow and results and deals to try and to fit into your week. With 20 holdings, when we're trying to find 3 or 4 new fantastic ideas a year, we can actually spend a lot more time on due diligence. Both before we purchase and after we've purchased the stock, in terms of engagement with the company we've invested in, to create an information advantage, and also to actually enhance the investment that we've made through active engagement with the management and board. We buy proven businesses. We don't do biotech. We like businesses that generate lots of free cash flow, or have the ability to generate a lot of free cash flow. And we're quite mean reversion focused. So we like companies that have had a certain level of profitability in the past, a certain level of percentage profit margins, which have then become depressed for whatever reasons. And we look to see whether those can mean revert back up to average, back up to the average that they were before. That's the kind of investing that we look to do. We look to see what needs to change, the catalysts that are going to make that happen. And then, as I've said, probably more than I need to already, we'll work with other shareholders, the board, and engage with management to try and get those catalysts to happen to drive returns in the companies we invest in. We also work out in advance an exit thesis, and a number of those holdings were taken over, and that's because we really want to understand whether the company we invest in, which we'll take quite a big position in, has got some options for trade sale, or will be attractive maybe to private equity when it's rehabilitated. We don't expect every stock to be taken over in our portfolio. Some of them will rehabilitate and then be bought by fund managers once the market cap's more in their range. But we've already, hopefully by then, at least doubled our money. The target life cycle that sits behind these stocks, I will do this really as quickly as possible, but it's something that I would hope all of you can understand. And as much as we look for businesses that have made strategic errors, or done some poor M&A, or the management have just got complacent or tired or become ineffective, and as a result, the profitability sort of drops, the returns on capital sort of deteriorate. Everyone gets a bit upset. They miss their numbers. They start going into this sort of profit downgrade cycle. Often that leads itself to kind of financial stress of some form. Almost always leads to a depressed valuation. And it's always very highly emotional, not just for shareholders who are sort of sitting on a loser, but also the management team who are under pressure, and the board who've overseen the issue. And that's the kind of conditions that we think are really exciting. If we can establish that the business can actually have a value creation realization strategy, that maybe that it is simply a question of just improving the management team or the board oversight, and maybe sort of de-risking the balance sheet, possibly through our injection of cash into the business, or maybe just through improved profitability, which generates more cash, which pays down the debt, which has caused the market to devalue the shares. Once you've gone through that whole phase, though, the business, does end up improving its returns, and profitability gets better, and then the market tends to put a higher valuation on it, and that's what allows and drives our return. This takes time. We are not day traders. In fact, our portfolio liquidity, when you take out forced liquidity as a result of takeovers, it's really, really low, single digit percentages. Most of our managers are up at 30, 40, even 50 plus percent. Even in small cap funds, you'd be surprised to hear. You should ask fund managers that question. But we basically invest genuinely on a sort of 3 to 5 year time horizon. Sometimes it's cut short because a bid comes in, but that's our time horizon. That's because that's how long it takes to stabilize the business. Once we've worked out it can be sorted out, that often takes 6 to 18 months. New management team, change the old one, establish all the problems. But then the delivery phase, which takes a couple of years minimum, an interims finals, and that's enough financial sets of results usually to see them sort of improving their profitability. And then either the stock market realizes that things are better, in which case it re-rates those stocks, or the outside parties realize it's much better now and they bid for the stock, realizing that the stock market hasn't worked that out. Or we will actually push that process as large shareholders and say, look, this is crazy. The market is just ignoring you. We need value to be delivered to shareholders. These are some of the chaps and chapettes, Zilla, who are in some of our portfolio companies, who have come in the last of in the stabilization phase, actually in the last sort of 12 to 18 months. I'll pick out a couple because I think they're particularly relevant at the moment. I think M&C Saatchi who's been it's actually sort of exec chair, has done a fantastic job at M&C Saatchi, tightening up their focus on costs, moving their multiple subsidiaries to a sort of shared cost approach across their global network of agencies, and also getting rid of and removing a number of loss-making or barely profitable agencies within the group to improve the margins. We've seen those now in the second half of last year get up to 16%. She's now actually appointed a new CEO and two highly regarded in the media industry creative directors, which the business has never had before. Business still has net cash. It's on a EV/EBITDA ratio of just under 5 times, and that's a really interesting situation now the new CEO has arrived, moving into the delivery phase. Trifast, on the other hand, has not quite finished its stabilization phase. We need a new CFO, which we've been suggesting candidates to the board, and they've got their own recruitment consultant doing that too. But Trifast is a business which Ian Percival's gone into. He's turned around the largest division at the company called Essentra, which is in the mid 250, proven businessman. And Trifast makes 5% margins currently, but for many years made 10% margins. Its peers make at least 10% margins, and we think that Ian is going to lead a turnaround in the profitability at Trifast, taking that 5% back up to at least 10%. And the process doing will create a lot of shareholder value. Business capitalized at less than 100 million now, with the market cap less than 100 million, with over 240 million pounds of sales. So we really do think this thing could at least double if he delivers the restructuring, which he started already and is planning, I'm sure, to do more of. Just finally, bottom right, Hostmore. Want to just nudge you all to have a quick look at over the next few months. It was a small holding. It is a small holding for us, only about just on 2% of Rockwood's in the fund, although we own a big stake in this business. It owns the TGI Fridays brand, which always creates some gasps of breath depending on your eating habits, but it's a very popular brand in the UK. It's actually the 4th most highly recognized casual dining brand in the UK, and it serves families often when they go to the cinema, but not exclusively, and it also serves the sort of office market as well quite well. It's quite a good thing for sort of retirement and leaving drinks. They do have a good sort of cocktail and value cocktail kind of approach, which is popular for large swathes of the population. Over 200 million of sales, this business. Anyway, the reason I just flag it is because they've recently announced a reverse takeover of the whole of the rest of TGI Fridays globally. Hasn't really been talked about because no one covers the stock, and Numis are restricted, who are the Deutsche Numis are restricted, who are the brokers. But not an easy market, casual dining at the moment. But the business is going to, us as UK shareholders, going to end up owning 36% of the total TGI Fridays brand globally, which is mainly a franchise model, which is a much higher quality, much higher, highly valued type of business than the UK hostable business, which just was a franchisee in the UK. Anyway, I've probably said enough about that, but I just flag it as one that I haven't talked about much to date, but I think is going to become quite interesting going forward. What has been super interesting is Funding Circle. So it was our main purchase of this year so far. We have done 3 others now as well, but this was the first big purchase. And Funding Circle, it just encapsulates so many things: how we approach investment, and the opportunities in the UK market. For those that don't know it, it's a technology platform that they've spent now over £100 million building, with loads of data points, very, very slick operation. And it basically facilitates lending to small businesses. These small businesses are things like florists and dry cleaners and other small businesses, often family owned, who just need modest or reasonable sized loans to expand or improve their business or their business premises. And, we just all know, I'm sure everyone on this call kind of knows, that the high street banks really are not being very effective in this part of the market. They're much more interested in lending huge amounts of money to large companies these days than small amounts of money to lots of smaller clients. Capture and Mannering, if you'll all remember from Dad's Army, is very much not the nature of high street banking anymore. So Funding Circle are disintermediating those banks, and Goldman Sachs floated it for 1.5 billion quid in 2018. Quite a lot of fund managers actually bought it thinking they'd make lots of money at 1.5 billion in 2018, but didn't, and it missed its expectations at IPO, and has remained loss-making, but gradually less loss-making. Has not been very good at communicating itself, communicating what it's doing and how it does things, and was got quite complicated because of COVID, where it was the primary lender of COVID loans, both in this country and a very significant conduit for COVID-related government loans to SMEs in America as well. But in February of this year, the market cap was £110 million, which is quite unbelievable in the context that the company had stated in the results that they had 175 million of cash in the bank, unrestricted, that they had an additional 50 million pounds in the bank of restricted cash linked to their regulatory requirements and business plan, and a loan portfolio of over 60 million pounds, which they've been reducing, but has been fairly marked to date. So no sort of major concerns about the value of that. So massive discount to book value despite the cash. So we bought 3% of Funding Circle as one of our investments, and we engaged with the board and the management team and the advisors about what we thought the problems were and how we thought value could be recovered or created. And we were absolutely delighted to see in relatively short order, in fact, probably the shortest order I've ever seen it in my career, them to sort of take everything we were on board. It's quite possible some of the things they were sort of thinking they were sort of on their to-do list, but had not really bothered getting around to doing them, such as buybacks. So they announced a £25 million buyback, which would be hugely accretive for shareholders to do. They announced that they'd had some interest actually in their US operations, which will simplify the group. It's the most loss-making part of the group, and we're very supportive of that. And it was great to hear that that was going to happen, and that their board was starting to evolve. Believe it or not, it had 11 members on the board in February. We're down to 10, and since then we've then engaged with them about cost cutting, which they've now subsequently announced they're going to do a significant cost cutting round. The CFO is also departing. And as you can see from the top of the slide, I'm delighted to say the market cap is now over 300 million, and we've made an absolutely fantastic return for shareholders in Rockwood this year. We still think this business has the potential to at least double from here. If you go, the house broker is Investec Bank, and Investec markets forecasts for next year for over 20 million of profit, and in 2026 they expect this business to be generating over 50 million of profit. Those numbers mainly updating actually, and probably will be updated in the next few months, but the potential profitability from the platform that's created if it was put on a proper multiple is very significant. So very excited about this holding, which is now a top 3 holding for Rockwood. I'm worried about my timing. I've been too verbose, sorry. Basically, these are core holdings. So these are holdings where we bought at least 5% of the equity, and we target 5% of the portfolio. However, Rockwood has been on a bit of a roll in terms of its growth. We've been issuing shares to lots of new shareholders during the last 12 months. And a small number of the holdings near the bottom here, we bought not sort of thinking that we'd be an 80 million pound fund at this point. And we can't actually scale the position with an 80 million pound fund. So they're not as large a position as we'd actually like them to be. But they are obviously, that is the case though with TriFast and RM and Flowtech, Flowpower. I make just 2 other points I always make when I present this updated slide, is that those are the Rockwood stakes in column 2, but Harwood, Mr. Mills, irregularly also likes our ideas, or sometimes the other way around as well, and he will buy as well. So at RM we've got slightly more than 14%. At TriFast we've actually got 15% at Harwood. Flowtech, Flowpower, the Harwood Group and affiliates have 29% of the business. And Centaur Media, we also have 29.9% of the business. I can also say, which is a real differentiator relative to other funds, is that we have board positions on 6 of the 7 stocks on this page. The only one we don't have a board position on is on Vanel, and we haven't asked for one there. So we really do get stuck in and make sure we're really on top of our core holdings. Our springboard and opportunity stocks are ones that could become core, but maybe the opportunity to buy 5% of the equity hasn't come up yet, either because maybe we can see that's going to happen through a fundraising, or we just haven't been able to accrue enough stock, but we know we want to start buying it. Or sometimes it's because we've done sufficient due diligence to buy a position, but haven't done enough due diligence or haven't got to know the business well enough to take it to a core position, and those are the springboards. And sometimes they're the opportunity positions, which is where we just see an opportunity in our part of the market, and we want to just use our capital rather than sit on cash. Where they will meet our target returns. They're often ones where change is already happening, but we think the market's sort of just, everything's in place for the turnaround, and we don't really have to roll up our sleeves as Harwood for the nenext stage, and we just want to make money for everybody. You can see a good mix of businesses here. Filtronic's been an absolute cracker in the last 12 months for the fund. They make IT hardware devices for radio frequency applications, which move from defense markets such as radar applications for things like the Eurofighter, through to 5G antennae installations for which Nokia, they're the preferred supplier to Nokia. But really what's got this market excited about Filtronic, and we're still very excited about it despite it performing very strongly for us, is that Elon Musk has actually, we think is actually his first stock he's bought in the UK, which is a great thing for those who want to wave our Union Jack a bit more. But he's taken warrants over 10% of Filtronic, which vest if he gives the business a certain level of contracts, which he started doing for SpaceX. And Filtronic are leading edge suppliers now for SpaceX for the Starlink satellite-based broadband offering, which he has around the globe. And it's a very exciting time for Fulltronic. They're currently in the base stations, which beam up the signals to the satellites. But we think that they are prototyping and trialing to try and get into the satellites as well, of which obviously there are multiples more satellites than there are ground stations. So very exciting situation there. But not getting to all of them, you can see there's a big mix there from infrastructure companies like Galliford Try, which builds hospitals and schools and has been doing a really, really great job under the management team there in the last few years, to James Fisher and Sons, which is a submarine rescue and defense and shipping services, to STV Group, which owns the ITV franchise in Scotland, but has been pivoting the business into studio production, to Restore, which charges companies to store cardboard boxes where they just sit there collecting dust and cash for shareholders, and it's now been run by a fantastic former CEO. Nearly there, and we'll get into Q&A, but essentially, I think I am on time. Brilliant. Structural issues are real but reversible. That's right. Okay. So this is just a bit of a backdrop about UK equities. I'm not quite sure the audience how you sort of think. You might be curious about UK equities, or you may kind of be, you may love it to bits. The reality is most people don't anymore. The top left chart, I think, is an absolute, is very, very upsetting. But it essentially shows that since the 90s, UK pensions used to own 30% in UK equities, and now they own at 2%. In fact, the House of Commons pension fund scheme only has 1.3% in UK equities. This compares to, say, Australia, which doesn't have as many companies as us, where the average pension fund there is 60% in Australia, France, which is at 40% in French domestic equities. Very sad. I think the DB pension schemes, is probably going to struggle to come back into UK equities. I think that's a horse that has bolted. But defined contribution schemes could start to come back into UK equities and maybe nudged by governments going forward. Indeed, the Mansion House Compact under the Lord Mayor Nick Lyons and the former Chancellor, and involving the large insurance companies, it's definitely maybe a starting gun for a starting. It definitely can't get any worse, can it, if we all look at that chart? So maybe it starts to come back the other way. There's a nuanced point here between the top right-hand chart about trackers and the bottom left picture, which for those that are beady-eyed can see as the original Magnificent Seven from that 1960s brilliant cowboy film. Sort of slightly, don't get too distracted, but it's noticeable the high diversity of the seven white men in the Magnificent Seven. I'm not sure that would be allowed these days, but the reality is the Magnificent Seven in America now are a very material part of their indices. In fact, the MSCI World Index is now roughly 75% US equities and 25% the Magnificent Seven. And the reason I mention this is that you do get to a point where the index concentration starts to actually undermine the point of having a tracker, which is meant to give basically, a much more diversified exposure, and global equities are meant to give a much more diversified exposure than UK equities, which a lot of people moved from UK to global because they wanted more diversification than the concentrated UK equity index. Anyway, I digress, but my point is that the trackers have been an issue, but I suspect what's going on might create a period of reflection. And just finally, the bottom right slide is the growth in private equity assets over the last few years. Absolutely massive, huge amounts of what they call dry powder, money that needs to be invested. And we think that's going to drive realizations for Rockwood Holdings. We think private equity are going to bid for some of our holdings. And as a result, we should get control premium for some of our businesses. Now, just to finish, just to point out, so the fees, we charge a 1% management fee and a performance fee of 10% of the performance over a 6% hurdle. The fund, as I mentioned earlier, is up to 80 million. We're keeping the costs overall under 2% ex performance fees. And we are listed on the main market with a premium listing. So I think, Ryan, that's it.
Indeed. Thank you very much, Richard. We've gone a little bit over time, but there's still plenty of time for questions if anyone would like to propose some. There have been some come in, so we'll address those in turn, but feel free to add further if you wish. We've had a couple about the portfolio itself, one of which is how do you compare to some of the other trusts under the Harwood umbrella, and particularly Odyssean?
Okie dokie. Yeah, good question. I think the first thing I would say about our comparisons with these three is that Harwood was not created with a sort of business model like a sort of list like the big fund management firms. There wasn't an idea of having a fund range, which mostly people have. It basically, Christopher Mills has been running North Atlantic small companies since 1982 and Oryx International Growth since 1996. And Odyssean Investment Trust, which Stuart Widdowson runs, was launched just about 7 years ago. They've just had their continuation vote and with a highly supportive shareholder base. So the differences are the big picture difference would be you always a different fund manager has a different kind of approach mindset and has a different outcomes. So just remember that. In terms of difference, North Atlantic has a very material exposure to private companies, about nearly just under 30%, I believe, of the trust, and is a much larger trust, an £800 million trust. The Oryx International Growth is more diversified than Rockwood, so it's just over 40 holdings, and I would say has a broader style approach than Rockwood, which is more recovery and turnaround biased than Oryx, which is more of a we'll look at growth special sits, has quite a lot more in kind of healthcare type sectors than Rockwood would look at. And I think with Odyssean, Odyssean has a max 20 stocks. We will end up in Rockwood having more than 20 stocks. It's we're looking to have 5 to 10 core holdings, like which we, as you can see, we've got 7 here now, and then we're actually looking to have more like 15 to 20 springboard holdings. And the only reason we're at 13 now is because of all the takeovers. We keep rebuilding it, and then they get taken over. So we don't want to rush that process. But in time, we'll be a bit more. We'll have a few more stocks than Odyssean. Odyssean also tends to look at a higher market cap on average than us. The last time I checked this, their average market cap was more like kind of 380, 400 million, that sort of thing. Whereas our average market cap is much below 200 million. You can see from the market caps here, we're much smaller. Those are the main differences. I would say though that they can blend together quite nicely. You could own all three. You definitely won't get the same outcomes in all three portfolios, but you could do that. I think that's probably as much as I can say.
That is useful, thank you. Actually, just a follow-up question to that. Does that mean that because of your very concentrated portfolio and your sort of market cap size effectively, there's going to be a sort of a limit to how big the trust can get?
Yes, absolutely. So we've said that the capacity is 250 million, and we do mean that. So I feel strongly, actually, one of the biggest issues with the fund management industry is being allowing good managers to end up with too much money to run. And so because we're focusing on the 250 million, that's the limit. That's the limit we think we can do the strategy as it's described. And the reason why that is if you just very basic maths, just to give so you understand it. Let's say we get to let's make it even easier math. 200 million market cap fund, currently 80. And I want to have a 10% position in a core holding. That would be a 20 million pound position, and which would be then 10% of a 200 million pound company where we would have decent influence, be able to act change. Once we think the opportunities of Rockwood are mainly under 250 million market caps. Once you go beyond, you actually you can't have enough of a stake to actually achieve what you want to. So that's why we sort of got 250 as the max. If at the current rate, which may let's say, temper. But at the current rate, the idea is to essentially, hopefully, issue sort of 10 to 15% issuance a year, and hopefully smoothed grow at 15% a year, which would compound the growth of the fund at 25% a year roughly, thus doubling the fund in size every 3 years. We're running a bit ahead of that at the moment, but that would suggest that, you know, if it sort of slightly slows from the rate we've been growing the fund and maybe the performance, we'd probably hit capacity in a sort of 3 years time, something like that. Yeah, I guess.
Great, thank you. I'm hoping that answers some of the questions we've had in about sort of the premium on the trust as well, unless you want to add any more on that, Richard.
Yes, I would, because it's quite important everyone understands this actually. So there obviously is a large premium at the moment. We do have a lot of demand for the stock. We are maxed out on our issuance right now under the rules. And today we've just announced that AGM is going to be on the 31st of July. And we used to have the AGM in September. We've pulled it forward to the earliest possible time we are legally allowed to have it. And in the AGM, we'll get permissions again for another 20%, and we'll start issuing again from the start of August. It's fair to say that, you know, we have a very loyal shareholder base who you know have been super supportive over the years. If you go further back, we had all kinds of fiddling around a few years ago, but we've got really great long-term supportive shareholders. So I would just I think that's enough information, but just be aware of that dynamic at the moment.
Yeah, that's very yeah, thank you for that. And this probably answered the question, but there was a question on gearing as well, which you don't use at the moment. Are there any plans to use it in the future?
No, no, we don't. We don't use it. We think there's sufficient risk in a microcap fund of our nature that's concentrated and has turnarounds, not to need gearing to juice returns. And you know, the latest numbers are roughly that the fund's up 200% in the last 5 years, about 130% in the last 3 years, and about 30% in the last year. You know, no need to gear that for everyone to be very happy.
Just had there's a couple more questions on the portfolio itself, and then we've got some more macro orientated ones. Can you just discuss the trust dividend policy, please?
Yes. So we're under the investment trust laws, we have to distribute at least 85% of the net income or less of expenses. So it's income received from dividends, less off the fund expenses. We have to give out 85% of that at least. So that's what we've just done. We've announced it today. In fact, we slightly topped it up to make it an even number, just to make it simple, to 0.6p. We're not seeking to, the current policy, we've just got too many opportunities to invest in. So we're retaining as maximum amount of capital in the fund rather than paying it out in dividends. It's possible that might change in the future. The board's open-minded to the best thing for the fund. The fund's had a slightly strange history in terms of its income policy, but for now and for the foreseeable future, we're going to retain as much of the capital as possible, but we'll pay out 85% of the net income. It's a small amount.
Thank you. And then one final question on final question on portfolio itself. Just asking for an update on Argentex.
Argentex, great. I knew I was going to get that. Thank you for that question. Yes, not everything goes right. In fact, that's quite an important thing to know. Not just Argentex, a couple of other things haven't been quite working out as we planned, but we still delivered, you know, best-in-class performance with not everything working, which is just an important thing to think about. So Argentex, we invested just over 2 years ago at about 70p a share. We actually, as an opportunity stock, we could see a very profitable business, but one which had been missing its expectations and had net cash, lots of net cash, but where a management evolution was going on. So one of the founders, the co-founders, one founder stepped down and the other founder became full CEO. He changed the finance director and they appointed a new CTO. And we thought that might be the catalyst enough. So we took a 2% opportunity position. We thought the market was just sort of ignoring it. And indeed, we also thought, because it's an FX services business, we thought that trading was going to be fine and people weren't really paying attention to that because of all the troubles the stock had. We were right initially, and the shares went up from 70p to, we actually sold a few at £1.37. My biggest regret of the last 18 months, not selling all of them at £1.37. I'm afraid to say I didn't do that. We sold some, it came back a bit, we sold a few more, and then we stopped selling. And then what happened is the trust volatility creates sort of bumper year for them. And the new CEO essentially didn't really model through effectively enough the future for what the likely pathway for revenues, Xing out trusts. They basically expected the business to keep growing and sort of kept some in for trust basically in their internal estimates, and then essentially ramped up the cost base materially. And as a result, you got a material profit squeeze came on. That's the long-winded way of saying it. And then the short-winded way is to say that team has proven not to have been effective, and the chairman changed and decided to change that team. So the new chair has replaced the CEO and the finance director. The CTO actually resigned. Part of the team, as it were, and the two new people are very professional and proven executives in the payments space. Argentex still operates a proven cash generative business model and does still have a strong balance sheet. They want to expand the business into alternative banking products. We won't go down that rabbit hole, but essentially more complicated products, but they cost money to develop. And the person that has developed them is Alpha, which some of you may know, which is an £850 million market cap business, but with about, I think, about 140 million of sales. So it's on a very high sales multiple and is very highly valued by the market because they've sort of got it right. Argentex is now valued at about 40 million or less, with about 40 million of sales. So on a very, very deep discounted valuation to if you sort of get this service right. So they've outlined a plan which has been backed by the board to invest in these products and build them out, which will take a little bit of time, and then hopefully they will start delivering the profits. But it's quite an investment phase, so the profit forecasts now are much lower than the level of profitability the business was doing before. We feel, just to get to the punchline, we think that they probably will get there in the end. It's quite a long process, and there is execution risk. There's little limited downside risk at the current share price, but we also think that the business would do well to merge with other players in this space. Equals is another listed stock. Alpha is obviously listed, and we think that you could plug Argentex's customers very quickly into those other businesses' sort of product suites, and it would create a lot of synergies. And we would be very open-minded to that. Anyone that made a serious approach to the business.
Thank you. Very interesting. We'll just switch gears quickly and move on to some of the markets and macro things. We've had an excellent question that really nicely segues this, is how much time do you spend on looking at macro versus micro when you're looking at companies and fundamentals? And for the latter, how important are balance sheets?
Yeah, okay. I'll do the latter first, which is balance sheets are really important. And actually, still to this day, fund managers in general, I think, spend not enough time on balance sheets relative to their kind of earnings estimates and P&L estimates. It also, and I learned this the hard way early on in my career, I've been managing money for 24 years now, that the balance sheets are the number one reason why you lose the most amount of money in a stock through equity dilution or going bust. And so we take balance sheets very, very seriously. I'm a former chartered accountant, by the way, so kind of enjoy that stuff to an extent. Not too nerdy, but I do enjoy looking at a good balance sheet. You'll see from this core slide that's probably still up, maybe on your screens, don't know, that three of these businesses have net cash. Pressure Technologies, very limited amount of debt. Flowtech's net debt to EBITDA is now at about 1.3 times, which is fine. And same with Trifast, debts come in, so that they're got a bit of leverage, but nothing material. RM is very leveraged. But we believe that they are going to, what we've asked them to, and we think they will end up selling at least one of their divisions, which will pay off all the debt, leaving the other two divisions unencumbered, which would de-risk that business. The company has a history of strong cash generation, so we're relaxed about that. If we look to Springboard, you'll see again, funding circle. We definitely look to the balance sheet for that. as I might have made it clear earlier, Filtronic again was bought with net cash. Same with MC Saatchi. James Fisher and Sons is what we think is going to happen with RM, in as much as when the last time I did this slide to investors, it had 150 million of debt, and they're about to announce that, well, they have announced it, but they're about to receive the cash from selling one of their business off, which is going to net them 82 million of cash, taking that cash down to 74 million of debt, which is fine. They're now in a normal place for gearing. On the first point between macro and micro, so I think I basically do a version. I do a sort of quarterly review of the main inputs that I think drive the stock market cycle, how macro affects the stock market cycle, and then that influences our general view on risk appetite across the portfolio. The key inputs being essentially the central bank setting, the credit conditions, secondly, that go alongside that, the economy, whether in terms of whether GDP is above or below trend, and then because they're never synced, where corporate profitability is on average below and above trend. We then look at essentially sentiment indicators around risk. Asset allocate. Sixth aspect is asset valuations on a long-term basis, where there may or may not be bubbles, and finally the second derivatives of all those things. So, for instance, at the moment we think that the interest rate setting is tight, but we think it's starting to loosen. So that's actually a positive. That's essentially a positive setting for markets. We then tend to sort of then take generally what the macro into kind of our confidence in market forecasts when we're trying to establish how trading might be on a nearer term basis. But, and this is critical, we can spend significantly less time on macro than most fund managers. And the reason why that is because the companies that we tend to invest in, whilst not immune from the macro, and it affects the pace of their turnarounds, essentially it's internal drivers, it's internal actions which are driving the majority of the profit growth or turnover changes that are happening in that business. A great example of that is as follows, would be back to MC Saatchi, because it's probably an easy one to sort of get the point across with. MC Saatchi is obviously exposed to advertising industries, although when you do the work on MC Saatchi, you'll find they've got loads of activities to do with communications, which are nothing to do with advertising and to do with strategic comms advice to the State Department, to NATO, to the UN, to the World Health Organization, that don't care what the economy's doing. But with their advertising companies, they will have to get their macro absolutely perfect. But we actually believe that this year, the MC Saatchi should be finishing Q4, which we're only a quarter away from, with a run rate profitability of about 40 million a year by the end of this year. Last year, MC Saatchi did 32 million of profit a year. So the profits at MC Saatchi are going to go up by 8 on 32 in a year of essentially flat GDP, and advertising just maybe starting to improve. So everyone else is depending on literally for, if you own WPP, for instance, really, you're hoping that you've got to get your macro right to get your advertising improving. The 32 to 40 million MC Saatchi is all about Zilla's collapsing down all the duplicated costs across the business and the finance departments and the office networks and getting rid of loss makers. And so where we don't have to be too worried about being spot on our sort of following the very latest ISM or CPI release.
Great, thank you. And then perhaps just one more, because I'm conscious we're very over time now. With that in mind, we're potentially having a new government and likely to be a Labour government in the next few months. Do you think this will have any impact on microcaps or your end of the market?
Okay, so I think it's discounted in markets a Labour victory. I think probably has been for some time. I think if one believes what has been said by the Labour front bench, then one shouldn't have material concerns about any of their policy settings, really. So I think that's not a big deal. My biggest concern would be, being frank with everyone today, is that they have obviously focused on the working person as part of their narrative, and the tax commitments they've made are clearly about working people. They've obviously that's unsurprising for the Labour Party. It means that capital does not sit under their acknowledgement as being a working person or the fruits of labour. So capital gains tax, I think, is the outlook is probably not looking good. Equally, it's possible that some of the reliefs on AIM get looked at some point. I think they've made comments they're not going to, but for now. I would urge all of you, I'm not trying to make a political comment at all, but I'd urge all of you to think about what, in as much as when the next crisis happens, which we're never very good at predicting, but when the next crisis happens, what things might be able to be permitted that aren't necessarily in a manifesto in the auspices of we're in a crisis. I would say this, though. I would say that private equity carry, it looks like they are going to get rid of the tax benefits of PE carry. And that actually will level the playing field from a tax basis between maybe private markets and publicly listed markets. So I think actually that might be quite an interesting dynamic over the next 2 to 3 years, where people are sitting on private businesses maybe because the tax benefits are better, but actually listing might become relatively more interesting now. They've also said that they're supportive of the British ISA, and I'd say 2 points on that. Number one, I'm going to say it, but I couldn't think of a better way to spend anyone's British ISA than Rockwood, which is invested in 20 small British businesses. So I'll put that out there. But secondly, I think Labour have said they're going to support the British ISA. And most of the commentary about it has been that it was a bit sort of slack at only £5,000. I suspect that it will at least start at £5,000, but who wouldn't want to be the Chancellor at the dispatch box saying that they doubled it to £10,000 in the future? So I think that'll be quite positive for UK small cap as well.
Well, on that very positive note, we will draw things to a close. Richard, thank you very much for your time and the extra time that you've given us as well. We do really appreciate it. We've had amazing participation as well. So thank you to everyone for staying and for all of your questions. If you'd like to find out more about the Rockwood Strategic Trust, please visit the website. The results analysis piece will be going up in the next 24 hours or so you can have a look through that. And if you would like to follow our events more, we'll be going the other side of the ponds to the US with Brown Advisory US Smaller Companies tomorrow, so please tune in for that. But finally, just leaves me to say thank you very much, Richard, for your time today.
Thanks very much, Ryan. Thanks for all of you that have listened in. I just summarise with this, is that we've had a really good period of performance over a sustained period with Rockwood. The portfolio's in really good shape. there are still our pipeline for potential investments is good. And I think sentiment around the UK is still pretty depressed. So we've sort of navigated a period where the backdrop has been quite tricky. And we've done that quite well. We're looking forward to maybe a slightly easier backdrop to continue our performance. But I would stress, as I've always said, is we invest on 3 to 5 year. We really do invest on 3 to 5 year kind of rolling basis on underwriting investments. Anyone that's considering Rockwood, please think medium term about any serious investment in Rockwood, and hopefully you can join the journey that we're all on. Thank you very much.
Thank you all. Goodbye.